There's a force quietly shaping our world, a river of money so vast it could buy every company in the S&P 500 and still have trillions left over. It's not a sovereign wealth fund or a shadowy cabal of billionaires. It's your pension. And the story of how it became one of the most powerful yet invisible engines of our economy is more shocking than you think. This isn't just about your retirement. This is about who really owns the world. Think about it. Every month, a piece of your paycheck vanishes. You're told it's for your future, your golden years. You get a statement once a year, a cryptic document filled with jargon and numbers that don't feel quite real. But where does that money actually go? It doesn't just sit in a vault gathering dust. It's put to work. Your money, combined with millions of others, creates a financial titan, the pension fund. Globally, we're talking about over $50 trillion. That's more than the economies of the United States, China, and Japan combined. This isn't just a big number. It's a gravitational force. These funds are the largest institutional investors on the planet. They are the silent partners in almost every major corporation, from the tech giant that made your phone, to the airline you fly, to the supermarket where you buy groceries. Pension funds own a piece of it all. But how did we get here? How did a simple promise of retirement security morph into a system that controls the commanding heights of global capitalism? The story starts simply enough. After World War II, companies wanted to attract and keep good workers, so they made a promise. Work for us your whole career, and we'll take care of you when you retire. This was the defined benefit plan, a simple, secure pact. For decades, it worked. The money went into safe, boring investments like government bonds, predictable, stable. Then, in the 1970s and 80s, everything changed. Inflation soared. People started living longer. The math got ugly. The promises companies made started to look incredibly expensive. They were on the hook for payments stretching decades into the future, and their safe, boring investments weren't growing fast enough to cover the bill. Panic set in. Corporate executives realized their pension obligations could bankrupt them. They needed higher returns, and they needed them fast. This was the moment the game changed. Pension funds, once the sleepy backwater of finance, were forced to become aggressive players. They moved out of safe government bonds and into the riskier but potentially more lucrative world of stocks. It was a seismic shift. Suddenly, trillions of dollars of patient capital started flooding the stock market. This wasn't just a small change. It was rocket fuel for Wall Street. The effect was immediate and dramatic. The demand for stocks skyrocketed, pushing prices ever higher. This created a boom in the 80s and 90s. The pension funds needed the market to go up, and by pouring money into it, they made it go up. A self-fulfilling prophecy. They became market makers, not just market participants. Your retirement savings were no longer just for your security. They were now a key driver of stock market performance and, by extension, corporate behavior. But here's the uncomfortable truth. When your primary goal is maximizing financial returns, your priorities shift. A company might decide to lay off thousands of workers to boost its stock price for the next quarter. As a worker, that's devastating. But as a pension fund investor, and that includes the laid-off workers' pension, that's a win. This is the central bizarre contradiction. The money set aside for workers' security is now invested in a system that often prioritizes shareholder value over worker well-being. The managers of these massive funds aren't evil. They're fiduciaries, legally bound to do one thing: get the best possible return for their members. They are trapped in the same logic as the rest of the system. If a company can increase its profit margin by moving a factory overseas. The pension fund, as a major shareholder, benefits. If a private equity firm, funded by pension money, buys a company, loads it with debt, and sells off its assets, the pension fund gets its cut. And this leads us to the even stranger world of alternative investments. When the stock market wasn't enough, pension funds ventured further into the financial wilderness. They became the biggest investors in private equity, venture capital, and hedge funds. They are the money behind the money. That hot new tech startup that just got $1 billion valuation. There's a good chance your pension fund provided the seed money. The new toll road or airport terminal being built in your city, probably financed by a consortium of global pension funds looking for stable, long-term infrastructure assets. On one hand, this is capitalism, working as intended. This capital builds our world. It finances innovation, infrastructure, and growth. Without it, our economy would grind to a halt. Pension funds funded the rise of Silicon Valley. They rebuilt industries. They are, in a very real sense, the architects of our modern economic landscape. But there's a darker side. This relentless chase for returns has created a system of immense complexity and risk. The investments are so opaque that sometimes even the fund managers barely understand them. And when things go wrong, they go wrong on a spectacular scale. Think back to 2008. The financial crisis was fueled by complex derivatives and mortgage-backed securities. And who were some of the biggest buyers of that toxic debt? You guessed it. Pension funds, desperate to meet their return targets. The stakes are constantly escalating. As populations age and returns become harder to find, the pressure mounts. Funds take on more risk, moving into ever more exotic and illiquid assets. They become entangled in a global web of finance, so interconnected that a failure in one corner can trigger a cascade across the entire system. We saw a chilling preview of this in the UK in 2022, when a sudden jump in interest rates nearly caused a doom loop that threatened to wipe out the country's pension system. It took a massive emergency intervention from the central bank to prevent a complete meltdown. This is the absurd reality we live in. The system designed to provide security for old age has become a primary source of systemic risk for the entire global economy. Your retirement savings are now inextricably linked to the high-stakes gambles being made in the Canary Wharf and Wall Street penthouses. So we are left with a profound and unsettling question. We created this $50 trillion behemoth to secure our future. But in doing so, have we built a machine that now runs on a logic of its own, a logic that may no longer serve our best interests? The river of money continues to flow, shaping our cities, our companies, and our lives in ways we are only just beginning to understand. The real influence of your pension fund isn't on your retirement statement. It's all around you. The question is, who is really in control?